Maybe some questions that we've had during the past 2 or 3 weeks, and there's more and more talk coming through from big analysts or analytic companies. The form of the recovery, whether it's going to be L or U-shaped or W-shaped, I'm sure you've seen a lot of that. But it appears that people or there's a bigger weighting be placed on a W-shaped recovery for what it's worth. So a lot of people are asking now in a typical balance fund or flexible fund, should you allocate more to equity now, or should you be a little bit more cautious? I think you did address some of it. You're looking through 6 months, 12 months forward. You're not looking to the immediate future or next week or the week thereafter. But would you gradually increase a global or local equity exposure now in a typical flexible or balanced mandate? Or would you wait for more green shoots to come through?
I can have my first crack at that. So in terms of like V or W, I think a lot of that has to do with the W is basically going to happen if we lift movement restrictions and there's mass reinfections and we have to lock down again. And I think that's not an impossibility, but we hope that it's a sort of low probability event. The V-shaped is very unlikely. I mean, we've already seen China, which has basically got almost no new infections on a daily basis, been unlocked for the better part of two months now. And there's still segments of the economy, of their service economy, that are operating about 50%. So despite the fact that movement restrictions have been lifted, confidence in people to return to the economy is still waning. So I would say it's very unlikely we see a V-shaped recovery. So it's somewhere between a V and a U-shaped recovery with an outsized possibility of a W. And I think that's a lowercase W, which is like two small U's, I guess. So in terms of answering your question about should we get back into equities, yes, we want to get back into equities, but we're in absolutely no rush to do that. I think in the near term, markets are being driven higher by a lot of the stimulus, both the monetary stuff that Nolan touched on and some of the fiscal stuff that I chatted about, and also the hope that there's going to be some form of economic recovery. And I think that's winning over the sort of longer term second order effects of all these job losses and things. And so I think we're happy to see more real data come through before we kind of dive back in. But we're sort of tentatively adding back risk, particularly in specific companies. As I said, the key for us is not necessarily the asset allocation, but in identifying the companies and the valuations that make those particular companies attractive. And then Pete's obviously touched on some of those. So if there's specific companies that we like for the long term and their valuations reach levels that we think is disconnected from their own individual potential recovery, then we're happy to add risk back, but not just sort of blanket risk back into the market now. We think it makes sense to be a little bit more patient.
Thank you for that. While we're on shares, I see there's some questions coming in, but the last one that came in, I think quite interesting, and we've seen a couple of graphs on emerging markets versus developed markets, or more specifically, value stocks relative to quality or anything, or to US or non-US versus US. Do you think that global value shares will rebound stronger than typical quality stocks or developed markets?
So I think one's going to have a bit of a balance. We are more biased towards growth shares as a philosophy, and we're certainly not dumping our growth shares. They remain the kind of core of our portfolios. But if the world does normalize, you obviously, what I was saying in that recovery portfolio, and some of those are great businesses, in fact, growth businesses that haven't suddenly become value businesses, but they become value shares. A lot of them are companies that there's one company that's grown its dividend for 49 consecutive years. So obviously, the shares that haven't gone down, there's a lot of shares that are still down 20, 30, 50% and will continue to be so. So we do think it makes sense to have a portion of those in your portfolio. We wouldn't necessarily be going into the classic value category where, value often implies poorer quality businesses that are very cheap. So, we would want to identify kind of growth shares that are trading at value prices. And then you also got to, just avoid the ones that can be permanently damaged by what's happening. The problem with, you see it, there's a few some of the big global funds that South African investors are in have done horrifically because they're focused on those kind of value equations, whereas I think some of those businesses are kind of flawed if you take a 5 or 10 year view. So there'll be a value category that will bounce back much more. Obviously, if something's down 50%, it can go up 100% back to normal. But I think that's kind of our approach. From an emerging market versus developed market perspective, I think at times of massive disruption like this, it becomes as simple as risk on or risk off. And developed markets go up, everybody floods into the dollar. The US is seen as a safe haven. The other developed markets like the UK and Europe do not as well. And then emerging markets get tanked from two perspectives. Their share prices go down and their currencies weaken. So when things normalize, emerging markets will come back. They can come back a lot stronger than developed markets. I think it'll take quite some time for that to happen. I think you also don't want to buy an ETF. There's specific emerging markets that are going to really take years to come out of this. But and obviously the currency is a big factor.
Thanks, Pete. And I think you also answered one of the big debates, people asking, should I buy the ETFs or active managers? And I think we've seen it in portfolios over the past month and a half, 2 months, where active managers tend to hold a lot better value or hold the value of the overall portfolio a lot better. And I agree with you, not really the time to buy or blindly buy a market or ETF. You've got to be selective in terms of what you buy. Nolan, an interesting question that came in earlier, if I can maybe direct this to you. And it does speak, you did speak to some of this, and this is about, SA leaving the WIGB end of this month. So if foreigners do sell our bonds, or if it's more of a sell-off in the bond market, is that not positive for SA investors then, because or SA as a whole, because the coupons will vest back in SA?
Thanks. Yes. So in terms of leaving the WIGB index, about 2 months ago, foreigners owned 37% of South African bonds. At the moment, it's dropped to 32%. So we've seen about 5% of our total bond stock sold back to South Africa. And there's a lot of speculation as to how much more will be sold back when we formally leave the index. I'm in the camp that we've probably seen most of it by now, but I know depending on who you speak to, you'll get different views. Nevertheless, that's quite a lot of bonds that have been sold back to South Africans. And most of those bonds have gone either into bank portfolios, and the banks are holding them as liquid assets, or they've gone into pension funds because pension funds are looking at 11% bond yields and going, that's actually a good return in the context of inflation at 3 to 4% for the foreseeable future. So that's got a couple of key impacts on the government. The first is every 6 months there were big interest payments that were being paid to foreigners, and that would go into our current account as foreign interest payments. The pressure on the current account should reduce. Interest payments are less. That's probably in the long run a little bit Rand positive. In the short run, we've seen the Rand come under pressure because everyone sold their South African Rand bonds, taking the money out. But this is another factor that leads us to believe that the Rand's probably going to recover. In terms of who owns the bonds now, it's sitting in SA banks and it's sitting with the pension funds. It's not, very, very few consumers actually are buying bonds. We've seen a few of them within Anchor. But it's typically most of the bonds are sitting in pension funds and banks. As a result of that, it's not necessarily putting cash into the consumer's hands, and it's rather rewarding them for saving, if I can put it that way. And it's pretty much future consumption. Which is good, but it's not going to give a massive boost to consumer spending right now. The other point I'd make is South Africa's actually got a heck of a lot of capital that's available for investment. Corporate balance sheets generally have a lot of capital. They haven't totally known what to do with it when it comes to investing, so they've gone offshore, sometimes with devastatingly bad effects. Sasol is a good example of someone who got it a bit wrong offshore. Alternatively, the guys have been sitting on big cash balances or paying out dividends, etc. So what South Africa really has been looking for is not access to capital, which is what the bonds coming back and paying interest and cash into South Africa would mean. What we really are looking for is profitable investment opportunities, profitable projects from government to get our economy going, and that's something we haven't seen enough of yet.
Thanks, Nolan, and staying with you. Also, a question that came in now, and it speaks to maybe ETFs in the bond sector. How does SA bonds stack up currently to competitors? So more specifically to other emerging markets. We've seen emerging markets like Mexico, Brazil also downgrading to junk status. SA bond yields relative to the rest of the world?
So we're a junk-rated country right alongside Brazil, for example, as you say. Some ETFs can't invest in junk-rated countries. They're probably busy selling out or have already exited their South African positions. By and large, from an ETF perspective, I guess it's rules-based, so it's less flexibility. But if we look at bond mutual funds where there is some flexibility, South Africa is interesting. Our real yields, which is the yield available on a longer-dated bond, our 10-year bond is probably about 10.5% right now, minus CPI, probably 4.5 gives me you can earn CPI plus incredibly high, even by emerging market standards. And the main reason it's high is that, the foreign selling that took place last month. So from that perspective, I actually think South Africa still is a very attractive value proposition for global bond market investors, albeit that the pool of potential investors is a lot smaller given the junk rating.
Thanks, Nolan. Staying on bonds, I know in your flexible income mandate you are starting to pick up a little bit more bonds. But if I run a building block portfolio and I want to up my duration of bond exposure, I think a lot of the questions we've been getting over the past 2 weeks as well is do we wait after in April the exit out of Whitby to up that exposure to buy your bond fund, or is it a case of bonds look through this and they actually anticipate this and I should actually get into bonds of one up duration right now?
I've been saying consistently that sooner is probably better. I think if we see a Whitby wobble, it's going to be a wobble. It's not going to be something that's long term, and we're just going to look through it. If you look at the peak of the crisis, which is around about the 24th of March, I was thumping the table. I was putting out articles everywhere I could saying, guys, you've got to buy bonds. The anchor bond fund since then to last night has probably returned something like about 15%. So it's been a very, very expensive waiting period for people who have waited. And I think that South African bonds are actually rallying today again. I think they're supportive of what the president did last night. And, it's probably sooner rather than later is my perspective.
I fully agree with that. Just the last question. We're almost out of time. What happened to credit spreads the last few days?
Domestic credit spreads have been almost impervious to the crisis. So we saw a bit of a wobble. We saw a bit of illiquidity at the height of the crisis. But if I look at bank credit spreads, and I think Anchor's been blessed, we've seen very, very strong client inflows over this period, and we appreciate the trust the clients have given us. But in terms of deploying that, actually, the credit spreads at which we're investing aren't that different to where they were pre-crisis. So, the very weak credit names, so, the bank tier 1 paper, the tier 2 paper in banks, which is subordinated, has come under pressure. A couple of the weaker names, a couple of the, listed property companies have come under pressure. But by and large, it's been very, very gentle on the credit markets.
Thanks, Darren. Very last question. It's not a question coming in from the audience, but I know everybody asks this continuously. Are you starting to maybe dip your toes into the property market? Peter, maybe from your side?
Yeah, we've got a big property team. I think we understand that market pretty well. I think some of the higher quality, first of all, let me just say that I think the value of property companies will not get back to where they were. I think properties changed somewhat for, in terms of people paying rent, and a lease agreement isn't what it used to be. But having said that, there's still fundamental values. So we think that property companies went down too far. We put out quite a bit of property stuff kind of nearer the bottom a few weeks ago. The quality stuff has bounced back somewhat. But I still think, we probably, if companies were worth 100 Rand, they're now worth, they might, if you look out and it normalizes, maybe those property companies are worth 80 Rand. But they tend to be trading at 40 to 50 Rand. So we think there is upside and there's a long road. I think the property market's going to be under some pressure because it looks unlikely that many of the property companies are going to pay dividends. The latest one was Octodec this morning, who elected not to pay a dividend. There's discussions going on with the Reserve Bank and the JSE, and the guys, they can pay out 100% of their earnings without paying tax. So the recipient gets taxable income. And so they don't get taxed as long as they pay out 75% as a dividend. So they're in discussions. And property companies are really in the hands of the banks at the moment because many of them are going to break their loan covenants. So there is underlying value. We're not rushing into more property exposure at these prices. Growth Point's got back up to 14, 15. If it went back down to the kind of 11 where it was, we'd be comfortable buyers. So I think one can still be patient. With one of the big concerns being they might not give you the dividends that you're expecting for the next 2 years.